The Federal Reserve just panicked into a 50 basis point rate cut, realizing that it was wrong about, well, pretty much everything this year. The Fed went from higher for longer and maybe we need more rate hikes to a 50 basis point cut is only the start in a matter of only a few months. So we'll take a look at how the markets are reacting to all this, plus a look back at how we got here, and then what it all means moving forward. That's the most important part. To start with, I did a video on May 4th where I said that rates not only want to go lower, they want to go a ton lower, and they'd be there if not for the Fed. And I showed how the markets were pricing zero inflation risk, even though at the time, that's all anyone wanted to talk about, including Mr. Powell. In fact, I also said the markets were pricing the 10-year U.S. Treasury far more likely to be back around 2%, 2%, even moving toward 1%, as any higher for longer nonsense. Because the economy had already substantially weakened long before even then. And as I went over in yesterday's video, it's all about hiring, not layoffs. We had experienced a deep freeze on the hiring front from last fall, and it has only gotten chillier ever since then. And I hate to say this for the umpteenth time, the U.S. economy is predictably in deep trouble, and the FOMC now basically agrees, for whatever that's worth. The implications are far more profound than Fed rate cuts or interest rates in general. It isn't even really about the recession either. There are long-run consequences that people are just now beginning to realize, and that may include policymakers at the Federal Reserve. From higher for longer to a 50 basis point September cut in the macro equivalent of a blink of an eye. What does that already tell you? Now, Jay Powell is going to say that this is nothing more than prudent action, an abundance of care, just in case the economy develops a little bit weaker than they thought. Don't you buy it? These are the same people who said, strong and resilient, higher for longer, inflation is our greatest risk, only a couple months ago. So when we step back and look at how we got here, let's pick up where we were in early May after the Federal Reserve got together April 30th and May 1st. Back then, conventional wisdom was higher for longer, inflation is still a huge problem. And when the minutes of that April 30th, May 1st meeting were released, here's how Bloomberg described it. Federal Reserve officials earlier this month coalesced around a desire to hold interest rates higher for longer, and quote, many questioned whether policy was restrictive enough to bring inflation down to their target. Minutes from the two-day Federal Open Market Committee gathering ending May 1st showed that while participants assessed that policy was well-positioned, various officials mentioned a willingness to tighten policy further if warranted. Participants noted disappointing readings on inflation over the first quarter, according to the minutes released on Wednesday. The minutes showed that it would take longer than previously anticipated for them to gain greater confidence that inflation was moving sustainably toward 2%. And when I did the video on May 4th that said interest rates wanted to go way lower, it sounded ridiculous, at least to those who pay attention to the Federal Reserve and the mainstream observers. Because the market itself was saying the vast majority opinion was for rates to go down and stay down. That's what the swap market was saying. The fundamentals in the real economy and the monetary system were for substantially lower rates. And they had started to go lower the previous fall, back in October when the bond rally began. That never ended. The sticky CPI and the transitory nonsense about consumer prices earlier this year was, well, transitory. And you could tell already by early May. Here's what I said on May 4th. Are interest rates going to crash? We do have a way to answer that question using the tools we already have at our disposal. And those tools show that not only do interest rates want to go lower, as they were starting to do at the end of last year, they'd already be there if it wasn't for the Federal Reserve and its interference at the short end of the curve. Take away that interference, suddenly treasuries rally. And I don't just mean the last couple days or back to last year's levels. The fundamental picture behind market interest suggests that 10-year rates would be maybe a 2 or 1 handle. Now, just a couple weeks ago, the very idea of something like that sounded preposterous because everyone said the U.S. economy was booming, and booming so much it was in danger of becoming even more inflation-y than it had been. More rate hikes, higher for longer, all of that. So while all of that may have seemed ridiculous at the time, how about now? Now that the FOMC has cut by 50 basis points and their dots, as we'll talk about in just a moment, show they expect a lot more coming relatively quickly. In other words, the Federal Reserve today just confirmed markets were right about pretty much everything up to including the economy. They won't say it in public. They have to continue to put a brave face on all of this. But the markets were right. We're in more trouble than anyone had realized at the start of this year when everybody was talking about no landing scenarios. Well, we're into the hard landing scenarios, and we're far deeper in the hard landing scenarios than most people wanted to acknowledge. As far as the market reactions go today, it's been rather muted. Now, I should mention that I'm recording this while Jay Powell is giving his press conference, so there's always room for him to walk back the 50 basis point rate cut, to sound a little bit less dovish, to not suggest that the Federal Reserve is panicking, which it clearly is. So maybe the market reaction turns around while Powell is talking, but initially there hasn't been much reaction in any of the markets, whether they be treasuries, SOFR futures, or swaps, simply because all of the reaction in the marketplace wasn't a reaction. It was more of a prediction or a move in this direction long before we got here. Market rates had already plunged before we got to today. While the Fed was still talking about higher for longer, and some Fed officials were saying we need to hike rates, market rates were going lower, forward rates were going lower, swap rates were going lower, everything was going lower for months before we got to where we are now. In the Treasury market, for example, the 3-month Treasury bill since May 3rd, which is the day before that video came out, the 3-month Treasury bill yield has gone down 50 basis points in a little bit over 4 months. The 6-month yield has gone down 86 basis points. The 52-week bill, the 12-month bill, 113 basis points lower. And on and on and on. The one we keep talking about because it's a critical maturity, the 2-year U.S. Treasury note, that's down 122 basis points. And these are all to yesterday, by the way, not today. Those are closing as of yesterday. So the 2-year is down 122 basis points since early May. The 5-year down 104 basis points. There you start to see the bull steepening. And the 10-year is down 85 basis points. So that's a huge difference between the 2 and the 10 because we're getting classic bull steepening. And a big part of that bull steepening in the Treasury market is Federal Reserve officials acknowledging why the curve is bull steepening in the first place, which is what they're doing. Again, they're going to play it down. This is just abundance of caution. No big deal. But the Fed does that at every single cycle. Think back to 2007, September 2007. In fact, September 18th, 2007, the Federal Reserve does a 50 basis point rate cut. In 2001, early January, Greenspan confronted with the idea of a dot-com recession, 50 basis points as only just the start. There were more 50s after that. That's why the forward rate market, SOFR futures, have moved even more aggressively than the Treasury curve has. These only go back to May 29th because forward rate markets got a little bit of a delayed start on this more aggressive move toward lower interest rates. So from May 29th, the December 2024 SOFR futures contract is up almost exactly 100 basis points in price. Being up in price means much, much lower forward rate projections. Again, these are not predictions of where 3-month SOFR is going to be at various points in the future. These are probability distributions that when prices go up this far, this fast, suggest that the market is increasingly confident, increasingly worried that something's going to happen that's going to depress interest rates a very long way in a very short period of time, which is consistent with the Federal Reserve cutting by 50 basis points in September, when only a couple months ago they said rates need to be higher for a lot longer, if not go higher still. The June 2025 SOFR futures contract is up a whopping 160.5 basis points just since May 29th. So again, while the Federal Reserve is doing its thing today, the markets aren't reacting to the Fed because they started reacting months ago, 160.5 basis points. And that continues to be the spot on the SOFR futures curve where a lot of attention has been focused between March 2025 and June 2025. The market's saying, if this is a recession, and it looks a lot like it, whatever's going to happen between now and then, it's going to happen. It's going to happen. Enough of it's going to happen so that between March and June, everyone will know the score. Everyone will know what we're talking about. Everyone will know what it is that has happened. And there's really not many scenarios that are consistent with short-term interest rates going down this far, this fast. The December 2025 contract, that's up 147.5 basis points since May 29. And like the Treasury market that I just went over, these are through yesterday. These aren't today, they're through yesterday. And SOFR futures before Jay Powell's conference, not really a whole lot of reaction to the Fed 50 basis point rate cut because it was consistent with everything that we're talking here. The one other development on the SOFR futures curve that we want to be aware of, over the last 3 or 4 weeks, going back to mid-August, late August into September, the SOFR futures curve has seen a lot more attention to the outer contracts, the farther maturity contracts, those beyond June 2025. And what SOFR futures have done, they've been buying in that part of the curve, hedging for rates going down even lower than previously priced. So the bottom end, the lower tail of the inverted SOFR futures curve has gotten even lower still, substantially lower over the last several weeks. Again, that's not about the Fed's rate cuts today. That's the market saying there's going to be likely more of them. And when they do happen, they're not going to work. Because if the Federal Reserve was going to be successful with the rate cuts and the market agreed the rate cuts actually did something positive, then what you would see is the SOFR futures curve become uninverted and turn more into a U shape, where the inversion meant that there'd be a lot of rate cuts, then those would work and interest rates would have to go back higher, more toward normal. Instead, the SOFR futures curve is beginning to look a lot like swap spreads. And swap spreads, the fundamental long-run view of all of these fundamentals, market as well as economy, as well as money and everything in between, have said since last summer, going back to last August and September, SOFR-based swap spreads have been moving more and more negative, especially since the middle of June this year. We got record lows in swap spreads, especially the 10-year maturity just recently. So wherever the swaps market was back in May when I was talking about how they were projecting lower rates, they're even more confident and assured in projecting even lower rates that stick around even lower for longer than they were a couple months ago. And the Federal Reserve panicking into a 50 basis point rate cut today is right in line with all of that. And all of these things are what we go over in Eurodollar University's deep dive analysis. And when we're talking, just yesterday, I wrote about the comparative urgency in forward rate markets, comparing Eurodollar futures in the middle of 2007, just before the Fed's pivot then, versus SOFR futures here in summer 2024. You'd be surprised at how much more urgency there is this time compared to 2007. Our deep dive analysis, we break down mainstream theories and assumptions. I show where they're off base and then go over what the evidence actually shows in extensive and careful detail. If you're interested in the deep dive analysis, subscription information for you at eurodollar.university. So while there's been very little market reaction today, most of the reaction was, as I said, leading up to today, the Fed's just confirming it. The Fed's projections that come along with their September meeting further confirm that the Fed is beginning to think more like the market. It's still far away from where the market is, but this is a process that takes a little bit of time. So we got a huge turnaround starting with the infamous dots. Now the dots don't really tell us a whole lot except what policymakers are thinking. The Fed was even thinking about some rate cuts earlier in the year. Again, that was consistent with their idea of a soft landing. That maybe 2 or 3 25 basis point cuts at the back end, middle part of the year and the back end of the year, and nothing more than that. That's all the Fed would need to do. But then the CPI started to accelerate because of insurance costs and oil prices that, rather than being inflationary as officials thought, as the mainstream says, rising oil prices, rising insurance costs were going to become disinflationary and harmful to the economy, which is exactly what we're seeing. That's what markets have been pricing on top of other fundamentals. So by June, the dots shifted to the point where many Fed officials were thinking maybe we don't have any rate cuts at all this year. The central tendency for 2024 as of June was up to 4.9 to 5.4. So maybe 1 or 2 rate cuts. They cut them back down because they were more concerned about consumer prices. But as of today, according to the latest participant projections, the SEP, now they're saying 4.4 to 4.6 for this year. So 4.4 to 4.6, remember the federal funds lower bound is 5.25. So they're talking about 75, maybe 100 basis points in rate cuts, potentially. That's the Fed, not the market. That's the Fed. The market's thinking much more than that. So even the Fed is starting to think we need more rate cuts in a hurry than we were thinking about back in March when we were thinking a gentle, soft landing. And 2025 shows the urgency too, the dots for 2025. The March dots for next year showed a central tendency for the federal funds rate, the federal funds target range, to be around 3.9 to 4.4%. So there would be rate cuts, again, the gentle, soft landing, gliding into it throughout this year into next year, 3.9 to 4.4% by the end of 2025. As of today, they've trimmed that projection by 0.8 of a percentage point, or three more interest rate cuts. Now they're thinking 3.1 to 3.6. Getting closer, but not really close to where the market is. And as I mentioned with SOFR futures and the back end of the curve, the tail end of the curve going lower, what the SOFR futures market's saying is those dots need to be adjusted several times over the next little while. And that's what the markets have been saying all along. Once the Fed realized that it was way behind the economic shift, it was going to fight to catch up. It was going to rush to catch up. And that's exactly what happened today. The reason for all this is quite simple. Unemployment. That's really what it is. The Fed tried to downplay the unemployment rate at several points along the way and in several different ways as it happened. As the unemployment rate started to rise, it said, who cares? It's no big deal. It's low anyway. And this is just the labor market normalizing. Then the unemployment rate continued to go up because of hiring. Hiring is the key. Hiring is what triggers recession. And by hiring, I mean lack of hiring. And that's exactly what we've seen since last year. So as it started to drive the unemployment rate higher, even the Fed started to realize that the unemployment is going up so much they can't ignore it anymore. They said, well, that's no big deal either because the unemployment rate is still relatively low and it's not going up because of layoffs. So they were wrong about layoffs being a huge recession trigger. Layoffs come later in the process. And now they're starting to say, well, we see the unemployment rate going up too far, it may be too fast. That's why we need to act with a 50 basis point rate cut. They are behind developments to a substantial degree, and the 50 basis point rate cut as a start, as we just went over in the dots, even the Fed knows there's going to be more coming, are the officials' attempt to try to catch up to the economy and where the markets are pricing, which is a lot lower still. So here we are. The Federal Reserve, 50 basis point rate cut, surprising pretty much no one, at least over the last several weeks, really since early August. Go back several months, though, back to May and June, and the idea of a 50 basis point rate cut from the Fed seemed absolutely outlandish and ridiculous. It was higher for longer. Maybe we need rate hikes. But that all stemmed from gross misunderstanding of what inflation actually is and what the risks to the real economy really were. That's where these market curves come in. They've been telling you all along, rates want to go a lot lower. And they would have gone a lot lower if the Federal Reserve had gotten its ass out of the way. But the Fed, they don't want to do that. They want to pretend that they're actually a central bank and that their policies mean something because the real purpose of the Fed is to be a lightning rod for the government, not actually a central bank. And so now that the Fed realizes the error, it is getting out of the way and the market is already zoomed way ahead of the Fed to begin with. And now the Fed has to catch up to both the economy and the marketplace. And the more important thing is what is it the markets have been pricing this entire time? We're talking about recession, we're talking about hiring, we're talking about unemployment, we're not talking about inflation. All of those combined into at least a recession, but the curves continue to go further and further, suggesting that this is more than just a recession over the next couple of months. This is more than just a lack of hiring that leads to an unemployment rate maybe leveling off around 5% instead of 4.5%. We're talking about a little more serious, a little bit more profound of consequences, set of consequences, than just some unemployment over the next 6 months. Because a U.S. recession changes a whole lot. I've talked about this in previous videos before. We're not going to get into it here, but that's where I'll leave you. The markets were right about all of this stuff. They were right about interest rates going lower, and now the Fed says, yeah, I see it too. I've linked the video that I did on May 4th below, and it's worth going back and revisiting those fundamentals from the perspective of early May. It's pretty eye-opening, I assure you. As always, thank you very much for joining me. Huge thank you. Eurodollar University members, Eurodollar University subscribers. If you want to become one, check out the DDA and the daily briefing and everything else. And until next time, take care.